Welcome to the Pride Education channel. Today, our most important topic is accounting cycle. So let's move on without wasting of time step by step. 1. Identifying transactions. The first step in the accounting cycle is identifying financial transactions. A transaction is any business activity that involves money and affects the financial position of the business. Examples include purchasing goods, selling products, paying salaries, or receiving cash from customers. Only those events that can be measured in money are recorded in accounting. For example, if a business buys furniture for cash, it becomes an accounting transaction because money is involved. 2. Preparing source documents. After identifying transactions, businesses prepare or collect source documents. These documents provide proof that the transaction actually happened. Common source documents include invoices, receipts, cash memos, debit notes, credit notes, checks, and bills. For example, when goods are purchased, the supplier gives an invoice showing the amount and details of the purchase. These documents are very important because accountants use them to record transactions correctly. 3. Journalizing transactions. In this step, transactions are recorded in the journal book in chronological order. This process is called journalizing. Each transaction is recorded using the double entry system, where one account is debited and another account is credited. The journal is also called the Book of Original Entry because transactions are first recorded here. For example, if cash is received from a customer, cash account is debited and sales account is credited. 4. Posting to ledger. After journal entries are prepared, they are transferred to ledger accounts. This process is called posting. The ledger contains separate accounts for assets, liabilities, capital, revenues, and expenses. Posting helps businesses know the balance of each account individually. For example, all cash transactions are posted to the cash account in the ledger. The ledger is known as the Book of Final Entry. 5. Preparing trial balance. Once all ledger accounts are balanced, a trial balance is prepared. A trial balance is a list of all account balances taken from the ledger. Its purpose is to check whether total debits are equal to total credits. If both sides are equal, it indicates that mathematical accuracy exists in recording transactions. However, equal totals do not always mean there are no accounting errors. 6. Adjusting entries. At the end of the accounting period, adjusting entries are made to update accounts according to the accrual concept of accounting. These entries include outstanding expenses, prepaid expenses, accrued income, and depreciation. Adjusting entries ensure that revenues and expenses are recorded in the correct accounting period. For example, if electricity expense is due but unpaid, an adjusting entry is made to record the expense. 7. Adjusted trial balance. After making adjusting entries, a new trial balance is prepared called the adjusted trial balance. This trial balance includes all updated balances after adjustments. It ensures that debit and credit totals are still equal before preparing financial statements. The adjusted trial balance serves as the base for preparing final accounts. 8. Preparing financial statements. In this step, businesses prepare financial statements to show financial performance and financial position. Major financial statements include income statement, profit and loss account, statement of owner's equity, balance sheet, cash flow statement. These reports help owners, investors, creditors, and management make important business decisions. For example, the income statement shows whether the business earned profit or suffered loss during the period. 9. Closing entries. After financial statements are prepared, temporary accounts such as revenues and expenses are closed. This process is called closing entries. The balances of these accounts are transferred to the capital account or retained earnings account. Closing entries help prepare accounts for the next accounting period by reducing temporary account balances to 0. 10. Post-closing trial balance. Finally, a post-closing trial balance is prepared. It contains only permanent accounts, such as assets, liabilities, and capital. Temporary accounts are not included because they have already been closed. The purpose of this trial balance is to verify that the ledger is balanced and ready for the next accounting period. Conclusion: the accounting cycle is a systematic process that helps businesses maintain accurate financial records and prepare reliable financial statements. Each step is connected with the next step, and together, they ensure proper financial management and decision-making in a business. If you feel the video is fruitful in the knowledge point of view, so please like, share, and subscribe the channel for the purpose of spreading of knowledge, and press the bell icon for the upcoming video. Thanks for watching.